Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Hi, I'm Martin Graf, Financial Edge Group. We specialise in helping retirees look after themselves and their investments and get up to retirement. Today, we're very fortunate to be sitting down with an expert from Lonsec, Dan Marati, who looks after the investment side of things, particularly the direct shares, investments in the portfolio. We're going to get some expert and answers from Dan and the team to kind of talk about some topics from today. And I guess that goes to the point of Lonsec's philosophy, and I think it's very much close to the lines with our philosophy that it is a buy and hold type of strategy. We're not trading in and out of stocks and buying this bank this week and then selling it next week because that bank's a better price and trying to make 10 cents here or there. But on the other side, it's not just buy a share now, keep it in the drawer for 30 years and never look at it. We do need to tweak and adjust and manage risk along the way. I suppose, do you want to give us a bit of a rundown about from a holistic point of view, Lonsec's approach and kind of like, I don't know, the turnover that we're trying to aim for and kind of what the philosophy is around the portfolio generally?
Sure. Look, the philosophy around that core portfolio, once again, it's quality at a reasonable price. That sort of simply means we look for good businesses that the valuation makes sense to us and they can grow for the long term. Ideally, we want to buy a business and not sell it, but obviously the depth of our market doesn't allow to have an entire portfolio of that mold. We've got to have diversification in the portfolio. So we don't want to have, just because quality, healthcare is quality, we can't have 70% of the portfolio. So we've got to make sure we've got embedded diversification in the portfolio and understanding how the underlying economic conditions feeds into some of the earnings of these businesses to make sure we have the right mix. What we do, our investment universe is the ASX 200 benchmark. We've built a number of quant models to just filter some of the key metrics of these businesses that are good sort of quality factors in terms of return on equity, the excess return on capital versus the cost of capital, balance sheet strength, gearing, debt, cash flow conversion and margins. Basically, that sort of filters out the lower quality businesses in the market. We trimmed that universe down to about 70 businesses that rank the highest within the respective gig sectors. We've got 11 sectors in the market, so we've got a short list in each of those 11 sectors. At that point, each of those stocks are allocated to our analysts. So we go through and conduct bottom-up research on those businesses, just to make sure that it's not just a quant thing. We want to make sure where is the quality, where is the strength of this business, is the earnings sustainable over the long term, and how can they grow. We value these businesses, so quality aspect is separate, the valuation is separate. You can have a really good business, but it just doesn't make sense from a valuation perspective to us, so we stay away from it. And wait for an opportunity for the market to present that to us if that may be so. Then what we do is sort of rank the stocks in each of those 11 big sectors to have we want to own the highest quality businesses in each of those sectors. We understand, for example, that resources is cyclical and volatile, but we cannot have not resources in our portfolio given that it's a third of the Aussie market. So BHP to us is the highest quality business in that sector because of its tier one asset classes, its costs, and its cash flow profile. And once that happens, obviously the portfolio is constructed, and our team continuously monitors the developments within these businesses. And look, the turnover is subject to market conditions. Historically, it's averaged between 25 to 30% per annum. It is a high conviction strategy, so 20 to 25 holdings. So typically maybe 2, 3, 4 changes per annum on average. During COVID times, we dialed up that turnover to some extent because we felt like it was needed. But there's been times where 18 months we haven't made a change because it wasn't warranted. Mm-hmm. Our analysts monitor the universe and our holdings. We meet with companies, we meet with industry sources to make sure that we're on top of things. And generally, there's 3 factors that could cause a transaction per se or a change. Firstly is that there is a change in the investment thesis for the business. So something material has to change for us to obviously change our view on that business, whether it's whether it's an M&A transaction, whether it's a management change, whether it's a strategy change, a regulatory change. We assess and look at that impact. If it changes our investment thesis for that business, then valuation is less important because that investment thesis is broken from our perspective. So that requires a change. Secondly is valuation grounds. So basically, it's the if all the growth projected for that business is captured in the current price, that's a catalyst for us to review. But obviously, given that we're a fully invested strategy, we need to have to find a better alternative holding within that universe in our portfolio. So that's the other catalyst from a change perspective, in terms of obviously better risk reward exposure elsewhere in the universe. And lastly, all our decisions are sort of discussed with from a peer review perspective, and all the decisions are done either at an investment committee level. Once again, from a risk management perspective, it's not one person just making all these calls. They are all ratified in action at an investment committee level.